Inflationary pressures continue to weigh down on our economy, and financial markets are still pricing in lower interest rates next year. But the timing of an easing cycle remains elusive. Our latest thoughts ahead of the RBA policy meeting next week. The latest GDP data showed further evidence that the domestic economy continued to decelerate in the first quarter due to inflated costs, rising tax payments and restrictive interest rates, although some relief is expected on all those fronts in the new financial year. Real GDP only rose 0.1% in Q1, and annual growth slowed to just 1.1%, the lowest year-on-year pace since 2020, while GDP per capita remained negative for the fifth consecutive quarter. Growth isn't expected to rebound in the second quarter, but from July, the Stage 3 tax cuts will start to support household incomes. And by the end of 2024, inflation should be closer to 3%, a level we haven't seen since 2021, which will be less of a drag on the economy. As for rate cuts to support demand, the RBA will need to be convinced that the underlying problem we have, high inflation, is fully contained. And the latest monthly CPI indicator didn't help that perception. Both headline CPI and core inflation rose marginally in the April data to 3.6% and 4.1%. And while this monthly indicator isn't as important as the quarterly numbers due in late July, this uptick, together with the uncertainty of the impact of state and federal budgets, adds to a rates on hold outlook. Similarly, uncertainty around how much of the tax cuts will be saved versus spent doesn't appear consistent with further RBA hikes. So our long-held view that the RBA will start cutting rates early next year remains unchanged. Other advanced economies have also seen stubborn inflation pushing back easing cycles, with the US on hold until September at the earliest, although both the Bank of Canada and the European central banks cut rates last week, a reminder that tightening cycles are generally behind us, even if easing cycles may be later and shallower as inflation takes longer to dissipate. Two other considerations for interest rates from here are labour markets, with the RBA dual mandate to manage inflation but at the same time to try to preserve as many jobs as possible, and also the ongoing trends in rental and house prices. The recent federal budget doubled down on commitments to work with the states to build 1.2 million homes by 2029. But house prices continue to reflect demand exceeding supply, with another 0.8% added to dwelling prices in May alone, and in the last 3 months, an increase of over 6% in Perth and 4.25% in Adelaide. How quickly supply can be added to deal with housing affordability will have consequences for inflation, but it's an uneven experience at present, with listings in Victoria and Tasmania sharply higher in contrast to other states and territories. And lastly, the Aussie dollar peaked around 67 cents last week, but was unable to break higher, so it remains in its recent range. But volatility across the markets appears to be building. And that's the market update from Bendigo Bank.